awesome. Thanks everyone for being here tonight. So joint event put on by YPE and ClimateLink. Before we get started with the guests, just quick overview of who we are. So I'm Sherry Totoki and work on the events committee with YPE. We're a nonprofit organization all over the US, and San Francisco has its own chapter. And there's, I think, 40,000 members nationwide. So we put on a couple events a month. This is, because it can get into a little bit more.
I think it's about our 6th event.
Yeah. So just wanted to welcome everyone.
So YP's also got a lot of really fun events coming up. We've got a Giants game, there's a wine tour, there's a Tesla factory tour as well, and overall they just host really, really fun events ranging from happy hours to fundraisers and that kind of thing. So I'm Kezia Wright. I work for a venture capital firm called Amaranth Vine. We're based between San Francisco and Dublin, and we're totally sector agnostic, so we invest across tech sectors, but I focus mainly on clean tech stuff, so looking at food technology, agriculture, energy, property tech, and the likes.
Hi, my name is Ravi Mikkelsen. I run ClimateLink. So we run our events through meetup.com, so if you came through the Eventbrite, you can find ClimateLink on Meetup. We host monthly tech showcases. So a few weeks ago, just about a month ago, we covered electric aviation. We covered AI and ML for grid management. We're doing electric vehicles next month. I also, ClimateLink as a company, we work to support startups, foundations, investors, connect with each other, and are currently working on creating an incubator in West Oakland. So if you need space and laboratory and fabrication, hopefully it'll be available later this year. So, thanks again.
Great. So I'm going to introduce our moderator, Julia. Excuse the cards. There's a lot of interesting things here to say. So Julia is the Managing Director of JMM Sustainable Finance. She's over 18 years of experience in utilities, private equity, renewables, and sustainable investments. She's advised and structured financings for clients such as Excelerator and BioFiltro. She was an MD at Ultra Capital, treasurer of Babcock Brown. She was at Equilibrium Capital, and she was a manager at PG&E, where she led a $9 billion PG&E utility refinancing to emerge from Chapter 11. So without further ado, I'll let Julia take it away.
Thank you. Can everyone hear me pretty well? Good. Thank you all, and thank you for having me here today. This is an excellent panel, and I'm really excited to be here. So we're going to kind of do some questions that we'll go through, kind of and ask kind of a series, and then be thinking of your questions, because we'll have questions at the end. So we'll be excited for that. So to start off, I want everyone to introduce yourself and also explain what part in the financing process you would help with.
Great. So hi everybody. Glad to be here. This is Danny Connor. I'm an investor at the Wesley Group. So we're a venture firm focused on seed through Series B, $2 to $5 million check size on average. We have about 40 portfolio companies across 3 funds. We've been investing since 2008 actually. So we've seen kind of the boom and bust of Clean Tech 1.0 and are still around, which is kind of a good sign. What we really look at is kind of 3 core sectors. One being energy, and that's informed a lot by some of our strategic LPs, including multiple utilities and auto folks. We also look at transportation, and we look at the buildings and built environment. And really, the core themes that we're looking at is electrification of the transportation sector. We're looking at proliferation of distributed generation at the grid edge, and then we're looking at the rise of autonomy. How do those 3 macro trends interact with the mobility sector, the cities and buildings infrastructure, and energy?
I'm Christina Borsam. I am the CFO of the New Energy Nexus. Some of you might know us as the California Clean Energy Fund. We recently rebranded. We're now blue and orange and no longer green and blue. Our mission is to support diverse entrepreneurs to build innovation and equity into the clean energy economy. We are not-for-profit. Sometimes we behave more like a fund, but most of the time we work in the very early stage space, connecting clean energy entrepreneurs with opportunities and funding and training and what have you. And we are successful as a metric if we can hand entrepreneurs off to the gentleman to my left and right, because then they've sort of made it out of that supporting environment stage that we want to get them through. we're probably a bit unique that we put a high value on equity, so that because disadvantaged communities suffer the most from the fossil fuel economy, so we want to make sure that through the clean energy transition, that issue also gets addressed and clean energy really for all everywhere.
Great, I'm Dan Baldy. I run the Energy and Resource Innovation practice at Silicon Valley Bank, where we provide banking services as well as debt capital into the clean technology and the energy space broadly. We have between 450 and 500 clients in this space, and they range from kind of seed stage startups to companies with a couple $1 billion in revenue, and we invest across that spectrum. And it is really broad for us. It's energy generation, storage, infrastructure, advanced materials, ag, air, water, food, electric vehicles, but we do have sort of three primary pieces, and these are electrification of transportation, the rise of renewables and storage at the grid edge, as Danny mentioned, as well as food and ag. And in all three of these areas we see that we're at the beginning of sort of monumental, fundamental change, and we're very enthusiastic to be in the space and supporting companies and entrepreneurs bringing technology to bear.
Great. Thank you very much. So Danny brought it up, the word clean tech, and the pearls of the word clean tech. And how do we get around kind of that, maybe it's known as a dirty word or dirty sector? How do you do that? How do you look at it?
It's a great question, and one that's we get quite often. So a couple of things. First, I would say, why did clean tech 1.0 fail? Many reasons. I think the first of which was a lot of companies had massive capital requirements, didn't quite understand what their unit economics were. Two, I think a lot of the investors didn't quite understand that either. And I think this kind of connection between the folks really led to what we see now as what happened in 2011, 2012, and so on. So, today, I think there still is absolutely appetite out there. There are increasingly more capital being pushed out by a lot of strategics, so corporate venture capital is rising and rising. We're seeing a lot of inbound interest from utilities, from auto folks, from large industrials, and how to push capital earlier on in this stage. And the other thing I would say is we've gone through that cycle, so there's a lot of retained knowledge through the investors that made it through, that there's still a lot of appetite from us as well. So I think how do we better get to clean tech investing today? It's a hyper focus on capital needs, really understanding what your scale looks like today, what your unit economics look like today, and where they'll be at level of scale, making sure that you're picking the right investors by your side, and making sure you're partnering with the right folks who understand how this business evolves. And then the last piece I will say is, again, there's other mechanisms to raise money, not just traditional venture capital through project finance, through debt, or through non-dilutive funding like grants and so on. So really being smart and intentional about what type of capital you're getting, which is a great reason for this panel today, I think will help as well.
Yeah, so all of what Danny said, we're sort of very much in the grant space. So understand, and I think to make it navigable, really understand your own value proposition and try to focus on, because clean tech, even back then, was such a broad issue, you really, if you can hone in and describe your pitch much better and get away from the buzzwords, and with that, find your capital source. What's the right capital for you? Who's interested in your clean tech product that you better be able to describe a whole lot better? And don't bark up the wrong tree, I think is one of the other ones. We just do clean energy. We love to see food and ag things, but we just can't fund them. So find the right good mix in your capital providers.
Yeah, those are all great points. I think the last one is the one that I feel most aligned with, and that is, making sure you find the right partners, the ones who understand your business, the ones who have an investment time horizon that fits well with your business, and you have to find partners that you can be honest with and who will be honest with you, and that's the best way.
Yeah, that's great. Now I'd like to kind of talk about the funding options, the fundraising options, and kind of the different stages. I want to start with Christina and talk about grants and other types of funding.
Yeah. So, and this varies a lot by geography. I'm going to start with that. So if we're going into the California space in particular, there's a lot of government support out there that gets channeled into programs like ours. So you won't be able to go as a startup to the California Energy Commission and ask for a small grant or something. But there are programs that we run that funnel that capital. So getting into the right niches. It's the Energy Commission, it's CARB, it's SBA, it's the Department of Commerce. Right now, the Department of Energy isn't so hot to access funds if you're from California, but generally that's also an option. But rather than looking just directly to those agencies and partners, look at the next level of intermediaries who provide that capital. And then oftentimes there's sort of this puzzle of building blocks. You get a grant, and then you can match fund that with another grant from somewhere else where you might pay a low, or a loan where you might pay a low interest rate. So unfortunately, in addition to figuring out your technology, there's quite the puzzle to solve on figuring out that funding landscape in the grant space. But there is actually a lot available. And so partnering also with somebody like Elemental, they have awesome resources on just to navigate that landscape. I think will really help get you there. It's not a cakewalk. You got to do a lot of research. You got to write a lot of grant proposals. It takes time. The second grant proposal is better than the first. Write your modules that you can plug into every grant application again. So the 10th is going to be easier.
Great, thanks. And Danny, on kind of the VC and the series and what that means.
Yeah, so I can talk kind of 3 levels, and I'm sure most of the folks in this room probably are familiar, but I can just talk through our lens at the Western Group. So we typically see three series stages in which we invest: seed, Series A, and Series B. So starting with seed, typically when we get engaged at a seed stage company, they're still in kind of the product ideation phase. They have some thesis that they think that they can put together. They have some potential customers who they've presented the thesis to, and they think that these customers will sign proof of concept or pilot customers. And they're really around trying to figure out product market fit, really from an early stage on. So the second stage on Series A, that is where we're seeing they've proven out that the model works with maybe 1 or 2 customers. We can go and back channel against those customers and say, hey, what do you think about company A or company B? How will you work with it in the future? Have you signed not just pilot contracts, but full production contracts? And I'm sure we'll come to that later around the difficulty, especially in the energy space, about converting from pilot proof concept into full production. And really, they're starting to see some level of recurring revenue with their software company, or some line of sight to being able to predict revenue. And then Series B is really taking capital. They have product market fit. They have the product up and running. They're ready to scale this thing out beyond the first N number of customers. And so I think it's important to talk to not just the firms and funds you're looking at if you're going after venture capital, around what stage they invest in, but also what their criteria are, because that's just how we think about it. If you look at any other investor in the landscape, they'll have a completely different look and feel around what stage they look at, and also how they qualify to various stages. And one thing we've seen completely change to date with the massive amount of capital that's being pushed into these private markets is that everything is becoming blurred and blended. So there's you can't really say this is definitely a seed stage company, this is definitely a Series A company. So I just encourage you to have those level of conversations with the investors, with potentially their portfolio companies, with their LPs if you can find them, or with others in the space, just to figure out where you would actually fit in terms of venture financing.
That's great, thank you. And then Dan, from the Silicon Bank side.
Yeah, I'd like to add on to Danny's answer before I move on, just because I can't help
please
myself.
do.
So I guess what I would say on the venture financing side is you need to find partners who are the right partner for you. And money is important, but it's only a fraction of what the right partner can provide. And so if you have the luxury of choosing partners when the time comes, fundraising time, be sure you're asking your partner what besides the money that they're going to bring to you, what connections they have, what experience in the space they have, what they can do to help you leverage your business into something powerful and substantial beyond the equity check. The equity check is important, obviously, and you want that, but many solid venture partners like Danny provide value that's well beyond the dollars that they provided. That's what makes companies bankable is kind of interesting. I mean, everything you think about banks is probably true, most of it at least, and that is that there's cheap money available. That might not be the first thing you think about. It's the first thing many people think about, but it's also important to understand the risk tolerance and the risk profile that bankers are willing to accept. Because, you know, when we have a loan, our return rate, for the sake of discussion, might be 6 or 7%. And the true risk of lending money to a startup company at the Series A stage is much higher than that. And so it's important to understand that we're loaning money and that we need to get repaid, otherwise our business fails. And so we're relatively conservative in that lending process. And so for early stage companies that are just beginning, they're in the R&D phase perhaps, they haven't transitioned to revenue, we're getting paid not from cash flow like most lenders do. Most lenders, go to Bank of America or Citibank and they'll say, show me 3 years of tax returns of positive cash flow and I'll do some algebra and show you how much I can loan to you. We don't do that, but where we get repaid is actually through successive equity rounds. So we have to be predictive about where a company's future equity is going to come from, and the best way we can do that is by understanding who's around the table and their level of commitment and their understanding that our capital is debt and must be repaid come good outcomes and hopefully not bad outcomes.
That's well said. And next I want to kind of think through, like, let's get an investor mindset. What are they thinking about? And how do you, we talked a lot about a pitch, I heard a lot about partner, I mean, really important things in your story. But maybe talk a little bit, let me start with you, Danny, talk a little bit about the investor mindset. What are they looking for when they're trying to get this?
Yeah, I think the number one thing out there is that you've done your research. So, we at the Weston Group, we have a very relatively narrow lens in which we look at, right? Three really core verticals. We also have a fairly strategic LP base. So if somebody comes in and has either connected with our LPs or investors, or has them as a customer, that goes a long way for us. They also know the industry, they know the space, they know the players, they know the people, and they know us. They know either our background or specialty, or we've met them in the past. So all three of those goes a long way. The other piece I'll say is what we look at for an entrepreneur when they come in and pitch is all the things that you hear from anybody else, any other generals you see. They're passionate about the industry. They are the right person to do what they're trying to do. They know their numbers down cold. If we ask about financials, if we ask about customers, if we ask about projections, it's not the CEO turning to the CFO or turning to somebody else. It's this person who knows their numbers cold, knows their strategy cold, and somebody who's also willing to be flexible and willing to recognize that they may or may not know something, and they're willing to go back and do the diligence, and they follow up with that. So if we ask them a question about a certain market, if we ask them a question about a certain customer, and they don't know, they don't make up an answer on the spot. They actually say, I don't know, I'll get back to you. And then within 24 to 40 hours, they follow up. So it's all about this. We're not just evaluating their business model, we're evaluating the team, we're evaluating the people. And we're evaluating whether or not we think that they can build this. Because ideas are a dime a dozen. It's really the execution piece that's the hardest one.
And let's get back how you ended up with ideas. And maybe Dan can maybe talk to us a little bit. But when does it kind of change from an idea to a company? In the mindset of an investor?
Yeah, it's a great question, and I think that ideas are not fundable generally. They have to be spectacular ideas, right? Because they are sort of cheap and easy. Teams are important. When I think about companies and what makes them investable, it's the combination of three things, really. It is the idea, the differentiation, the market pull, the size of the market that's available for the company to pursue. It's the team. It's how, what they have done before, either their success has been in the past, or what is their specific experience that applies to this case that means they will be successful this time. And the third thing is, like, what are the protections for their idea? So what keeps competitors out, what makes them special in the marketplace, what will be their competitive advantage in the space to differentiate them over time.
Just following up on my earlier comment, so what we try to do is get people ready so that they can have a conversation with us too, right? So when we have entrants in our grant programs, awesome technology, more idea stage than company at this point, but then and what does it take to have the conversations so that here's what you're going to expect when you walk into Danny's conference room. Are you ready for this? Do you know what to look for? And you're the awesome technologist, but you actually need somebody who understands business operations to build your business plan. Then can you talk to your business plan? How do you work up a business plan? How do you do your market size calculations, iterative, and just getting into the mindset of doing that? Also to broaden the pool of ideas that actually make it through to these guys, because there are a lot of awesome ideas out there that don't make it into the execution stage. And it's this balance of listening to the wisdom of those people who've done it before and encourage you to write your business plan, do this, do that, and also staying true to yourself and being authentic so that these guys think you are the right passionate ones. So that's what we're trying to help. But I also think that's really important for aspiring entrepreneurs to sort of get the first glimpse of that those are the stages you're going to go through before you get to talk to these guys.
And I think, venture capital dollars or bank debt should probably not be the dollars that are used to validate your business idea, right? And that those aren't the best sources of capital for that function. It's really hard to get them for that purpose. And so whether it's grant money that's available, whether it's friends and family money, whether it's your personal money, unfortunately, venture capital and bank debt are not easy to access for unproven ideas.
Right? So now I'm thinking about, a lot of people may ask, like, how much should I raise? You want to start?
Sure. There's kind of two potential outcomes in this conversation. One is answers as much as you can, right? So if you have 5 venture investors that are interested in you, maybe it is prudent, especially in the current economic environment, to raise more than you need. But I still don't advise startups when asking me about that. So the answer I give is you should structure your financing rounds against business milestones, right? So at your seed stage, you should have hit milestones that you wanted to hit that were in your business plan for the last 1 to 2 years from company inception to seed. If we come in at a seed round, you should have 3 to 4 milestones, maybe against product, maybe against customer, maybe against team, whatever have you, that you need to execute against in order to get to your Series A. Because then, as an internal investor, we have confidence to participate in future rounds. And there should be a capital need associated with that raise. And I think running efficient with capital is incredibly important because you show that you can be good with a marginal dollar. And we're prepared to back you. So when we make an investment in a company, we don't make a $2 million investment and say, you're on your own for the rest of your career as a company. We make a $2 million investment expecting another $5 to $8 million going into this company over the life cycle of the company. And all other investors at the table typically have reserves set aside similarly. And these reserves are effectively unlocked by making these milestones happen, right? So that gives us as investors confidence in managing against these relative milestones. So for me, it's all about what are the milestones you want to hit before unlocking the next phase of financing, and what is your capital needs associated with that? Sure, add some safety factor, add a little bit of buffer, but I think that is probably the most recommended outcome in this case, because that gives us confidence as investors to come back to the table in your next financing, and because you did what you said you're going to do. And for us, if we look at, doing a startup's hard. If you do what you say you're going to do over 18 months, over 2 years, for us, that really goes a long way.
In the grant capital world, the amounts are usually set for what you apply for, but it's sort of a similar concept that we already want to see, that you have a game plan for the money you're applying for. Probably true for all the other rounds too, but you've got to start thinking about your sources of capital pretty early, and you've got to start thinking through a bunch of milestones ahead, because the relationship building takes a long time, so you kind of need to know what you need in 18, 24, 36 months so that you can start having the conversations, so that will fund in 24, 36 months, and that's actually the same on the non-dilutive capital. You got to think ahead, you got to plan ahead. The plan will always change, but having that plan in mind and constantly adjusting is another validation point that you're serious about it.
The plan always changes.
Yeah.
So I'm more in the as much as you can eat, as much as you can get kind of camp, with that in mind. And that is, I haven't had a single company tell me they wished they had raised less. I've certainly had companies who wish they spent less.
Big
And so I
difference.
think spending discipline goes along with that raise more than you need as a cushion. I think that's sort of the best advice that I can give is if it's offered, you should take it within reason, but hoard that money. And the time for spending it freely is kind of in the ramp-up customer acquisition phase when you're really bringing direct value to the company by adding revenue and hopefully cash flow and value to your customers. That's when you can spend freely. You have to be stingy with the money before then.
Great, that's great. As far as metrics, how do you guys think of the metrics, and what are the key metrics that these companies should be looking at, making sure they have? I heard at the beginning, unit economics is just essential, and I've heard that time and time again, some startups I've worked with. But what would be some things your tips on metrics?
I think unit economics are fundamental, and unit economics in today's market and in kind of any market you can envision. Right? If you think about where clean tech went wrong in the beginning, right? Solyndra is a great example. It's the example of companies going bad. And Solyndra was an okay technology that was geared towards undercutting the price of silicon, which was expensive when the idea for Solyndra came around. But a lot of silicon production came online when Solyndra was bringing its product to market. Prices, dropped by 90%, and their unit economics no longer worked on that basis. And it wasn't that the technology didn't work; it was that the unit economics didn't survive in the future that they didn't anticipate. So it raises examples of subsidies and commodity price risk. And if you're selling into power or the fuel markets or other commodity markets, you need to be aware that commodity prices fluctuate, and they can fluctuate wildly over short periods of time. And if your business can't sustain a shock to pricing, then it's a very risky business.
Yeah, I would add, so in the grant world, again, you might have metrics that you just have to report on. That's a condition of the grant. So that you just have to deal with, and if they're not meaningful to your business, find the quickest back of the napkin way, don't tell anybody about it, and move on, just report it and move on. If they get aggregated up and nobody really cares, and I didn't say this out loud. But I just also think don't go into metrics overload. Try to metrics that work for you and manage against them, be really aware of them, track them all the time. But if you open the GIIN, this one of the Impact Investor Network lists, you're going to find hundreds and hundreds of metrics. Don't try to go after every one of them, but try to find a couple ones that really work for you and track forward and backward.
And the last thing I would add is anchor your metrics to what stage you're at. If I'm looking at a seed stage company, I'm not going to be asking what their ARR is, what their EBITDA is, any of these kind of core business model metrics. I'm going to be looking at their product cycles and how efficient have they been in engineering resources and converting into their product development cycles, or how efficient are they in signing up new pilot customers. Or if I'm looking at a Series A company, it's all about pipeline throughput, how they from first inbound into conversion of pipeline. So it's all about anchoring to what stage you're at and picking the couple metrics that are most important. Again, it's setting those goals and executing against them. I cannot tell you how important it is to say something that you're going to do in 12 to 18 months and then do it. From an investor mindset, that is one of the most important things we have in this conversation.
And then what are some common pitfalls that happen in our love to avoid if you had known before, and some of your clients had?
The hockey stick revenue growth, always we see it, always we see it. And even in companies that are absolutely are on fire, they still don't see what they've. We had a company in our portfolio that projected. This is one of the best portfolio companies that we have, and projected, going from 10 to 40 to 100 to 200 million in revenue, and it's just not possible. And so whenever we see that, it loses a little bit of credibility within the entrepreneur. It's hard if everything was a hockey, especially in clean tech, right? When you're dealing with physical assets and moving electrons, it's really hard. So that's an immediate call out that I identify. There's many others. But,
That's a good one.
I think Danny talked about utilities as customers. That's an important thing to consider. Consider who your customer is. Consider what product you're selling. Selling to utilities takes a monstrous amount of time. And, you know, they have a network and a customer set of their own that demands 99% uptime. And so they're not willing to risk that to try new products. And so they might buy a few and then try those for a few years, and they'll buy a few more and try those for a few years. And maybe in 5 or 7 years they're gonna do a broad rollout. That takes a lot of time, a lot of equity capital to get your company through something like that. In a similar vein, if you're not thinking about products that sell into utilities, if you're in the energy space at all, or in the transportation space, or in the food and ag space, you're selling a capital-intensive product. Those are difficult products to sell, and long sales cycles, and revenue doesn't come with it.
That's great. And we, Dan mentioned earlier a little bit about moving from pilot to commercial, and what you need to think about and when you need to think about it. Any thoughts on that?
I'll go back to the stage point. For us, if it's a Series A investment, you don't have a production customer, you're probably going to have a hard time investing. And so I think that's going to be the biggest. The point is figuring out what stage you're at in the raise cycle, and where you're at in your customer journeys.
Yeah. Any other thoughts?
It's hard to be a seed stage company with a deep customer roster, right? It's difficult to do. And yet investors and lenders really love to see revenue traction. So customers who have a path to significant sales beyond a handful of trials, I think the more enthusiastic response you're going to find. All that's
And I'd rather see a company with 1 or 2 production contracts than 20 pilot contracts, right? So there is a lot of value in being laser focused on getting that initial couple customers on board and really into kind of production environments. That is very valuable because, again, the type of customer that we're dealing with most often is incredibly difficult to get that conversion done.
Yeah, and with that, you think about the time, how much time is really allowed in the investor's mind from pilot to commercial,
Yeah, the answer is it depends. It really does. For us, these pilot, typically what we like to see is as short of a pilot as you can manage to be kind of proving value to the customer. So 2 to 6 months is really, I don't like pilot contracts that go longer than 6 months. And really then you're entering into negotiation phase. That can take anywhere from 6 to 12 months, right? So that gives you a sense of timelines that we look at.
And even if your objective, if it's not possible to obtain a massive contract, which sometimes it is difficult, right? Seeing repeat customers, even on a small basis, from repeat transactions from the same customer, is validation, right? That somebody is willing to move beyond a pilot.
Yeah.
If I step just a little outside that, is because I'm going to advertise some of the programs we've done. There's actually some value in, I think, trying to find a customer through programmatic avenues. So we've worked with utilities and sort of created that environment that's a bit of a safe space to build those utility connections for the first time, or in the battery space, trying that out when you're in an environment that's not very adversarial and you're not alone in the room. There might be a couple of other startups that the companies can also work with, and maybe you can step back if it's not the right environment. We were more skeptic to begin with, and really started believing in the concept and replicating it, that those more programmed interactions with potential customers actually work quite well.
Customers are often providers of capital,
Yeah.
too, right? Joint development agreements, where you're working together with your customer to make your product meet its needs. Those can be very meaningful from a non-dilutive capital perspective, but also as validation that you're working with someone who's engaged and interested in buying the product.
And then how do y'all think about companies that have, we talked about a few of them that have a lot of projects that they're doing, and a lot of them are funding it with venture capital money, grants, and so forth, but when should they really start thinking, and how should they start thinking about non-dilutive capital sources like project finance and other sources?
Project finance traditionally is a well-banked market. It's dominated by large banks, Asian and European banks predominantly. And their appetite for technology risk is near zero. So if you look in the markets where they're active today, they're active in the infrastructure market, they're active in the solar market, they're active in the wind market. But solar and wind technologies, those are 50, 75-year-old technologies. That's why the banks are there, because they're comfortable with the asset ownership risk. When we talk about project financing, traditionally that's non-recourse financing to a sponsor, so asset-specific financing. And banks are willing to take the risk when they know there's no technology risk. It's really just discounting of the cash flows that result from the operations of those assets. So traditionally, the first project or two are done with equity capital, whether that's VC money or other equity capital. Then traditionally there are non-bank financing institutions that come in, private equity funds that are often structured very much like a venture capital firm and offer expensive debt capital to bear some equity-like risk in the technology risk that's evident there. SVB has a project finance practice, and we're typically the first bank financing into projects. But we like to see lots of hours of production data so that we can get comfortable that if we lend serious debt capital into these structures, that the cash flows will result to repay the facilities. So, we're a little closer to the technology spectrum given our focus on emerging companies, but still we want to see pretty proven technology so that we're not overexposed.
Yeah, and I would say a couple things. First, on the grant side of the house, we always appreciate non-dilutive grant funding coming into the picture, even if it's after our equity financing. So for us, it's an entrepreneur showing that he or she is creative with regards to keeping burn as low as possible and understands the marketplace and all the opportunities out there. And then in terms of project finance or debt lending from banks, equity capital from us is really expensive if you think about it. If you're financing projects with equity capital, again, it's incredibly expensive. So the moment you get an SVB ever on the table that's willing to put project finance out there or other facilities in place, we tend to support that.
Thank you.
No, that's great. So I don't know how we are on time, but I have one more question that I thought about.
Plenty of time.
Plenty of time, okay, good. Okay, so what I'd like to then do is, I'd like to, we talked a little bit about the story, and you guys see a lot of pitches, and I think, so how do you either coach or what makes a successful story in the whole pitch?
Yeah, I can go first. I think for me, it's a couple of things that I've talked about. So first, you have done your research. You know us as an investor. You know companies that we've invested in. You know your company. You know the ecosystem. So that's one piece that's really really important with regards to crafting your story. The other piece, is you have a vision for the future. Even if we know things always change. We know that the path you set out on today is most likely not the path that you'll end up on, even if you are incredibly successful. But you really need to paint us a strong vision for the future, and you need to show that they're supporting and corroborating evidence around macro and micro trends that are out there. So it's doing your research up front. It's being authentic and being yourself and being comfortable in the environment, but it's also painting a laser-focused view of the future, even if it's not aligned with necessarily what I think, and you have all the supporting data. Those all go a long ways.
Yeah, I would add, so if I sort of think back of the worst pitches that I've seen.
That's good.
I think what sort of makes us cringe in the room is not wanting to listen, or either being too nervous to listen, or just generally not wanting to listen. That can sort of really make for a toxic atmosphere in the room, and then you've lost it, right? As soon as there's no coming back from an adversarial reaction in the room. So listen to your audience, know your audience up front. Some Some funders might react better to a certain story or a certain angle, grasp them. Do your research as you do for your industry, do your research on the audience. And I think in addition to being passionate, if there's a simplicity in it, like a simple story and just the craft of storytelling, to add on to that you just capture the room, never hurts. So practicing and really thinking about that delivery, not just about your technology, might go a long way.
Investors are investing in people, right? And so you have to be convincing, you have to really believe it, you have to be credible, and then you have to have thought through the story you're telling, and it has to be, you have to be able to win people over. And they have to view you as capable, either the person or a key person, to get it done, because they're investing in you as the avenue for building something great that the investor wants to be a part of, the lender wants to be a part of, the grant provider wants to be a part of, contributing to something significant. So you have to believe it yourself. And CEOs, entrepreneurs tend to be self-selecting in that regard, in my experience. Most of them are true believers, but they have to have done their homework. And I think listening is absolutely great advice. You have to watch the body language in the room. You have to listen to the questions that are asked and answer them, and not brush them off or argue. Or if you're arguing, you better be right, because your ability to overcome someone else's objection is a difficult thing to do.
And I would add one last piece. Oftentimes, within 5 minutes of a meeting, I can guess the background of the person I'm talking to, whether they're an engineer, a technologist, whether they're a product-focused person, whether they're a finance-focused person. And oftentimes, I find the most compelling pitches are those in which I don't know where their background lies, and they can just as easily go deep into the numbers as they can talk about the technology and the product. So those, work on practice and go deep on weaknesses as you go into these pitches.
And how have you seen maybe someone bringing in a personal story or reason why they're building a company and kind of bringing that into their pitch? How is that kind of the room feel, or does that make a difference, or sometimes yes, sometimes no?
Yeah, I think it starts, especially if it's an emotional story, it starts the conversation with empathy, and that always leads to a better conversation. It's not, it's more of a supportive avenue. It's not necessarily will get you funding, but it just gets the room in a more empathetic mood, which always helps have a more honest and comfortable conversation.
Yeah, I agree with that. I think being relatable is extremely important. You have to be relevant at the same time, right? If you think about a pitch or an idea that's very personal to you, it has to be personal to a large market. Otherwise, it won't be a great investment opportunity. So it has to be both personal and relevant.
Yeah, and sort of the negative piece, if it's just a personal story, that isn't enough.
Yeah.
So you've got to back it up with product.
Definitely a balance. Yeah. We mentioned this partnership, and partnership in the sense of investors being there for the long run. And so many just say, oh, it's about money, and it's not at all. And can you guys touch on that a little bit? We know it's important, but what that means, and it can be the sector, it could be a lot of things, or what they bring to the table, it could be strategics they bring to the table, but just touch on a little bit of that.
Yeah. It's hard to tell entrepreneurs, you choose who you want to be at your table, when sometimes they only get one offer and they have to seriously consider it. But I think in kind of separate of choosing who your partner is, there's a lot of things. For us, we're thinking about this as a 7 to 10 year relationship, right? This is effectively getting married for the long run. Oftentimes we'll take a board seat. So if I'm a board member for my companies, I'm now sitting in a board meetings every year. I'm talking to the CEO of the companies I'm on the board of every 1 or 2 weeks, right? So this is a long-term relationship. So think about the strategic value that they can provide, obviously. Think about the capital that they can provide, obviously. But also, you got to think about culture. You got to think about the person themselves and whether or not you get along with them, because you don't want to marry somebody that you don't get along with.
Yeah, and along with that, since we see a lot of earlier stage company, I think there's value in thinking through what you are looking for in a partner, not just money, but where are your areas of weakness that they can help you with? What are the kind of introductions you're looking for? The thought partnership you're looking for, sort of try to make it a two-way street and think about that strategically before you seek partners, because I think that will help you guide that conversation and not get flustered if something comes up that maybe you hadn't expected, but you sort of thought it through.
Yeah, I think the marriage analogy is a great one. These are real partnerships where people spend real time together. Their interests need to be aligned. People don't necessarily need to see things always the same way, but they need to be working towards a common goal. And making sure you want to spend time with that person, the person you're inviting into your company, the person you're inviting onto your board, the person you're taking equity or debt or grant capital from. It all comes with expectations and some level of commitment. You just want to make sure that you're spending time with people you want to spend time with.
So everyone's still be thinking questions, but so really last question from me, and you can, this is for you to think about, but what would you like to leave for this group based on our conversation today and from your experience as advice?
Yeah, I think my one piece of advice is be surgical and not throw things at the wall and see what sticks. So really think about how to, for the fundraising process. So think about really being targeted and tactical about who you're raising from, why you're raising from them, what stage you're raising at, what type of capital you're looking for, and think critically about the needs of your business and making sure those match with the needs of your investment.
Coming from more the idea stage, I think one of the things we often see is the underappreciation of teams early on, and the underappreciation of sort of 1 + 1 is actually more than 2. Going it alone, even at the pitching your idea stage, makes it a whole lot more difficult than with partners, entrepreneurial partners that you want to found your firm with, even at that early stage. You want thought partners bouncing ideas off, makes it a whole lot easier. And you build resilience because the entrepreneur journey is hard anyway, and you go through a lot of ups and downs. So if you've got some partners in crime that can buffer the bad times, that's probably better for the long run.
Yeah, I think interest alignment, as a continuation of the last question, is key, which is, if you're building a company in the clean tech space because you want to build a big, profitable, valuable company, well, venture capitalists might be interested in helping you with that. If you're building a company in the clean tech space because you want to have a positive impact on the world, the environment, your life, if there's not a big business associated with that, venture capital is probably not the right place to go to get funded. Right? And making sure that that you're bringing the right people along who believe and support the mission that you're trying to achieve is the best advice you can give.
That's great. So, open it up?
Yeah.
Yeah, okay. Question here?
So we haven't talked about public policy. How do you think about policy as a positive and as an encumbrance, especially when it impacts unit economics? I'm thinking about things like regulatory credits and tax credits on things.
I view them as nice to have. So if your business is based on them as a must-have, then you're at real risk. Right? Regulatory risk is very difficult to estimate in the future. Right? You think about solar tax credits, or you think about renewable fuels credits. Right? Those things can go away. So they're designed to sunset generally. Sometimes they're continued, sometimes they're not. They can be very helpful in getting people to the unit economics and the scale that they want. But it's way better to have a business that can survive without them than it is to have one that's dependent solely upon them.
I had to write them down. Talk about services that you guys can provide to companies that you more of a partnership. I would imagine that some of that is if you're looking for a VP of sales or something, they could maybe come to you. You guys might have somebody like that in your network that's looking. What other services besides financial do you guys provide?
Sure. I mean, so we're a bank and we provide banking and financing. We provide foreign exchange and letters of credit and investment management and a suite of products internal to the bank. We have a network of VCs. We have a network of family offices. We have a network of corporate venture capitals and strategics interested in investing in this space. We have a network of customers of our customers, right? That could be customers of the people that we work with. You know, the Valley is kind of its own unique ecosystem, and people understand that well. The energy community is a similar ecosystem in many respects, populated by different people. And so if you're operating a startup company in that space, it's also good to have network on both sides of that fence.
Yeah, and for us, so we absolutely have a talent person on staff that we help with hiring needs. That's one absolute service. I think the other service we provide is access to potential customers. So you mentioned some of our strategic LPs. The moment we pull the trigger and wire into a company, we put them in front of our LP base and help facilitate those conversations as a customer. And then the last piece is access to additional capital. So we have long-standing relationships with not just equity investors, but also debt providers and project finance providers. So it's just you get kind of the full doors open as soon as that investment takes place.
And what kind of percentage do you guys generally try to hit the target when you're in the Series A or the C round? I mean, I would imagine it's probably don't want to get anywhere near 50% or above. But,
Yeah.
At some point, you get forced to on a company, I would imagine.
Yeah. So the answer is it depends. I think a lot of venture firms out there will have an explicit mandate to get a certain percentage of equity, and that's not how we operate because we are relatively comfortable flexing up or down in terms of stage. If we take a board seat, we tend to be the ones leading the round, and our positions tend to be less than 20%. Broadly speaking, again, it completely changes depending on that. So I think it depends. For us, we really are much more conscious around valuation and pricing. So how do we look at the fundamentals of the business and evaluate what the valuations that we can be a company with investors. So we're much less ownership focused and much more valuation focused.
How often do you guys say yes?
So broad strokes, we see 1,500 companies a year. We do 10 investments.
So I think to understand kind of how you guys think about having an honest conversation with the people you might be investing in, especially when it comes to financial projections, because as you said, not everyone's going to have hockey stick growth, but obviously as someone trying to raise capital, you're probably going to pad your numbers a little bit because you want to look attractive to the investor. So how do you think about, again, kind of getting to what that real number is and making sure there's an honest conversation between investor and entrepreneur?
So I think from us, the first thing is not shaming them into not you must execute against this. And so a lot of it's having a conversation like, look, we understand that this projection it doesn't seem realistic to us. So give us a P90, give me some P50, P90, and P95 on your revenue projections. Give us 3 scenarios, and let's have an honest conversation about what are the sensitivities around those scenarios, what are the assumptions made behind those scenarios, and what plan you have to execute against those assumptions. So it takes a little bit extra work for sure, but it's about having that honest, non-shaming, non-negative conversation about projections, and then having this scenario modeling to understand what's really driving the various opportunities.
Danny, what percentage of your portfolio companies hit the P50?
Maybe 10%.
Yeah.
Maybe
so
10%.
nobody believes the number.
Yeah. It's common to. I mean,
But guys,
it's a
you
game.
don't want to lower your numbers because then they're going to lower them even farther.
But we're not trying to screw you over, right? I mean, like I said, we're also entering into this marriage. So it would not behoove us to basically nickel and dime a company to death in terms of evaluation. We want to come up with a fair assessment and not crush the founder who's put his whole life into it, or her whole life into this company.
That's a great point. I mean, the question on ownership percentage is valid. And it's like, if you're giving up 75% of your company to do a Series A round, that doesn't leave you anything for your founders or for the next investors in the company. It leaves you without a fundraising path, right? And so that's not a recipe for success. That better be the last dollar in if you have to sell it at that price, right? And so that's the balance. So I think thinking all these things are related, right? Thinking about the alignment I'm thinking about the life cycle stage of the fund who you're taking money from. How many more years of investment are they planning to do out of that fund? Do they do cross investments out of other funds? Are they needing to liquidate this investment in a 3 to 5 year time frame? And are you going to be able to help facilitate that? If you're not, maybe it's not the best partnership. Right? Those are the kinds of honest conversations that both sides should be willing to have, which is like, how does this match fit?
Can you guys talk about any sort of off-consensus views that your firms have, either thematically or subsector-wise?
I really think that the utility should own the mobility and car infrastructure of the future. And so we're thinking a lot about what that means for the utility, better than the low cost of capital, large asset base, rate-basable in regulated utility environments. So we're thinking a lot about how, and that's one area that we're really looking at.
I don't know. Off consensus. Autonomous driving and flying cars and smart cities are great ideas that are super hard to implement because we don't have the strategic will to do them as a society. So our cities aren't adopting and supporting and regulating to allow the deployment of technologies that are expensive to adopt. And so while technologies may be ready, adoption cycles will be longer than anticipated. Yes,
Others, I thought I saw a hand, yeah. Go ahead.
All of you mentioned food and ag as sectors that you are interested in. Can you talk about the type of ideas that you're drawn to in that space?
I'm going to start by, we love food and ag, but we can't fund it. We don't do clean energy. So unless there is a real compelling intersection with energy, we'd love to see your growth, but it won't come with us.
Sure, I'd like to talk about that. I mean, I would start by saying that I think I see ag as an undisrupted economy, in that we've been doing ag fundamentally the same way for 100 years, right? Maybe our tractors are a little fancier today than they were 100 years ago. So the application of robotics, of machine vision, of data analytics, data manipulation, provide meaningful abilities for increased production and increased efficiency. I also think that climate change and soil degradation trends mean that we're not going to be able to farm the same way in 100 years that we farm today. And so that lends itself to things like indoor farming. And I think there's just a tremendous opportunity in those sectors. Also, conveniently or inconveniently, farming is a huge user of energy and petroleum resources. It's a big polluter, and so it's an area of rice for disruption from that perspective as well. So lots of opportunity, lots of reason to focus on this space. Huge market, maybe the biggest one.
Byron Packer with Company. As a company who's decade plus old, established, hundreds of past clients, it seems like that team you were talking about and like the uncertainty of like, will people trust us to do this? Like, we've proven all of that. It seems like a strength, but I know there's probably some weakness to it as well. Like when people come to you that are established companies and they're saying, hey, we're here, like we already have the structures in place of a CFO and a CEO, et cetera. Is there something else that you say to them like, well, then why are you here? Or what's the hidden flaw?
Yeah, I mean, if the strategy that you're pursuing is similar to what you've done over the last decade, if the customer base is similar to who you've dealt with in the last decade, the biggest concerns we have is we like to see exit in 10 years from kind of inception to exit. And so the concern would be what is the growth vector and what can our additional capital really help hit that inflection point. And it's a little bit less clear when you have a company that's relatively mature and really understanding how does that kind of inflection point happen.
To speak for Danny seeks investments, single ones, that can return his fund.
Yes.
Right? And you might have a business that, I'm not talking about your business, but hypothetical business that 10 years old, 15 years old, may be a very nice business, maybe a profitable business, but if it doesn't return his fund or have the potential to do that, it's not a great fit for the capital that he's trying to deploy. And maybe a different source of capital will be a better long-term partner for you.
Yeah, and in that, my follow-up was, what recommendations do you have for building a board of directors? Because I know that we take the venture money, you'll put yourself on the board. But if we went to Silicon Valley Bank, would you guys put yourself on the board?
No, I mean, we will not do that. There's reasons for that, and that lenders are prohibited from managing the companies that they loan money to. So that's good hygiene from a corporate governance perspective. But my advice would be to find good outside board members who aren't investors who also bring additional value, whether it's customer relationships or technical expertise or production expertise, whatever it might be. There are people who can add value to your business who don't bring checks.
And does that come inside your network ever? Or
Sure.
do you feel like
Sure.
it's too mixy, too muddy
No.
waters?
For us, for SVB, one of the things that we feel like we can bring to the tech community is a network, right? And that we're exclusively focused on tech. And so we've got a great network of entrepreneurs, we've got a great network of investors, we've got a great network of strategic participants in the technology community, and we try to bring those individuals and groups of people together for networking and with content.
Other questions? There's more.
How do startups find you guys? How do they come to your
There's many different avenues, ranging from cold emails to qualified references to unqualified references to bankers. So the most meaningful approach is to figure out a warm reference, right? So that shows great hustle from the entrepreneur side. Because the energy ecosystem is relatively small in this area, that is highly preferable. But sometimes we get a lot of inbound from other folks as well. But for us, if you want the team to really sit down and take a look at the business model, the business plan, the pitch deck, and get the most likely outcome of taking a meeting, it would be coming from a qualified reference and more intro to us.
So for us, it's very different. We obviously want to lower the barrier as much as possible. So the easiest is to literally subscribe to our newsletter, where we curate challenges, funding opportunities, acceleration programs around the world for clean energy ideas and companies at various stages. And deliberately, we want to lower the barriers. So the more the merrier in terms of clean energy entrepreneurs that can ultimately help us in the clean energy transition.
Well, we get our customers probably 20% from VC referrals, probably 20% from repeat entrepreneurs, probably 20% from the temp CFO community, the finance community, and the rest sort of just find their way.
Yeah, I know for a lot of companies looking for grant funding early on, a lot of that grant funding is reimbursement based, right? So they have to use it for a specific purchase, and then that gets reimbursed, and that takes time. How do those companies deal with that time lag? And if it's for a specific purpose, how are they funding the rest of their business? And what do you see from the companies you work with, and how they manage that?
I lose a lot of sleep over that. A lot. I have talked to a lot of people at the Energy Commission, at CARB. Thankfully, the U.S. government programs actually have implemented policies that turns that around, so that you can actually get advance funding. You should be looking for smaller grants because they can do advanced funding milestones based before you hit the milestones. If you see something that's below $150,000, you've got a pretty good chance of getting the money up front. And then we try to connect. There's a lot of creativity that you might have to work with. There are very few lenders, CDFIs, or anything that want to fund on a government contract or even government grant. But we try to find angels that understand the program. Sometimes even within the entrepreneurial community, they might have somebody who's financed and they can refer. It's a constant struggle. We're actually sort of working in the background of trying to figure out some facilities that can help those companies.
Yeah.
But it's a well-known issue that drives us crazy.
It's really interesting that under 150, you can get it pretty easily. But not pretty easily.
Not pretty easily, but there's
interesting
some legislation, so actually kudos to the Obama administration, got to throw that out, because they really worked on those regulations. They're roughly 500 pages long. Nasty to read, better than a dentist visit, but that's about it. But there is some structuring around it that they've neatly done, and now we're trying to push that into the state systems, that they, now that this model language is out there. I'm very actively working on the Energy Commission, so hopefully 2 years, 5 years from now.
Right.
Fingers crossed.
Any other questions? Great. Sounds like it's a wrap. Well, thank you all for being here, the panelists, and thank you ClimateLink and YPE for having us all here today. I didn't know if you guys wanted to say anything.
Yeah, just thanks so much, Dan, Christina, Danny, and Julia. It's been a really, really interesting conversation. And to move, from the cerebral and kind of business talk to the more kind of idealistic and philosophical side of things, smashing records outside in San Francisco heat-wise. And, it's really great that everyone's come here to kind of support the clean energy and clean tech space. And I really hope that we can continue to do so, and through ClimateLink and YPE, it's a great way to get plugged into that network. So come along to the rest of our events for the year, and get involved in any which way you can. And thanks again. It was a really, really interesting conversation.
Thanks to everyone for coming.
Yeah, thank you.